What if I told you that insurance policy you bought 5 years ago could be costing you thousands of dollars more than it should? And worse, it might not even cover what you think it covers. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Here's something I see all the time. A family comes to me wanting to refinance their home. We run the numbers, everything looks great, and then we get to the insurance discussion. That's when I hear, oh, we haven't looked at that in years. Our premium went up again, but we just pay it. Sound familiar? Let me share what happened with a family I worked with recently. They bought their home 8 years ago, set up their homeowner's insurance, got their mortgage, and moved on with life. Fast forward to last month, their insurance renewal came in at $4,200 a year. That's up from $2,800 they paid when they first bought the house. They figured, well, that's just how it goes, right? Wrong. We did something simple. We reviewed their policy and got some quotes from other carriers. The result, we found them comparable coverage for $2,900. That's $1,300 a year back in their pocket. Over the life of the 30-year mortgage, that's $39,000. And we've got the insurance agents to refer you to. We know them. Think about what that means for your household blended interest rate. That extra $1,300 a year, it's like having an additional expense charging your interest you don't need to pay. But here's where it gets interesting. It wasn't just about the premium. When we actually read through their old policy, we discovered something concerning. Their coverage limits haven't been changed or adjusted since they bought the home. In 8 years, construction costs have gone up significantly. If something catastrophic happened, they would have been seriously underinsured. So what does this mean for you? Your homeowner's insurance isn't just a line item on your mortgage statement. It's part of your overall financial strategy. And just like we talk about refinancing when rates dip, you should be shopping your insurance regularly. Here's my recommendation. Review your homeowner's insurance every 2 years minimum. And I mean really review it, not just glance at the renewal notice. Look at your deductibles. Maybe when you bought your home, $1,000 deductible made sense because money was tight. But if you've built up your emergency fund and could handle a $2,500 or $5,000 deductible, that change alone could save you hundreds of dollars a year. And we've talked to you before about checking with your CPA and financial folks and see if a Roth IRA would make sense to put the savings in. That way you become self-insured for that deductible. Not self-insured, but you're insuring for that. You've got a safety net for that deductible going up. And think about it. When was the last time you made a claim? Think about that part. Check your coverage limits. Make sure they actually reflect what it would cost to rebuild your home today, not what you paid for it years ago. Special form policies are popular because they cover all perils except those specifically excluded. But do you know what's excluded in your policy? Here's another thing people miss. If you have valuable jewelry, art, or collectibles, your standard policy probably doesn't cover their full value. You might need additional coverage for those items. And don't forget about umbrella liability coverage. If you've built up assets over the years, an umbrella policy provides extra liability protection beyond your standard homeowner's policy limits. It's usually inexpensive relative to the protection it provides. Bottom line is this. Insurance is part of your debt management strategy. Every dollar you overpay on insurance is a dollar that can't work for you somewhere else. It affects your cash flow. It affects your ability to build wealth. It affects your retirement. I work with trusted insurance professionals who can provide second opinions on your coverage and rates. It's not about being disloyal to your current agent. It's about making sure your insurance strategy matches your current financial situation. You know it. Strategy beats rate always. But in this case, the strategy includes making sure you're not overpaying for the protection you need. Want to see how your insurance fits into your overall financial picture? Of course, rsrlinks.com/keysteps. rsrlinks.com/keysteps to access our financial house in order tool, or go to ronsiegelradio.com to learn more about strategic debt management. This is Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management, reminding you that every dollar matters when you are building wealth. That is the Borrow Smart segment, brought to you by GetHomeselect.com.